investing, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. I am excited for this episode. We have a veteran of the Australian finance industry, someone who came recommended to us by another expert that we interviewed. So I'm excited to pick his brains and see what we can learn.
Likewise, love a good reco, and it is our pleasure to welcome Wayne Jones to the studio. Wayne, welcome.
Good morning, guys. Pleasure to be here.
So Wayne is the co-founder of Gains Capital Management and portfolio manager for the Gains Focused Value Fund. Since the inception of the fund in 2002, Gains has returned 12% per annum compared to 9% for the ASX 300 accumulation index. So as Ren said, been in markets for a while, plenty of experience for us to tap into and unpack. So let's get going.
Yeah, Wayne, 20 years of outperformance. You love to see that. And we look forward to delving into it. But we want to take you back to the start, for the start of this interview, to the very start of your investing journey. Can you tell us the story of your first investment?
Sure. Well, I was studying accounting and I'm an accountant by background and always loved the stock market. And so when I used to go to uni, there was an investment newsletter there called Ridges newsletter, as in Ridges Hotel. And so I used to go up there and read that newsletter in the library every time I was at the uni. And they had a little stock tip in there for a company called Pacific Tires. So this is the early 80s, a company called Pacific Tires. And they said, we think this might be a takeover candidate. And sure enough, I bought the stock. And sure enough, a month or two later, there was a takeover bid by Dunlop. And so that became part of Dunlop Olympic. And so I made money. I thought, how easy is this? I was hooked. And it was all downhill from there for about the next 10 years.
So we love to start by understanding the investment philosophy that our guests take and then go from there. So how would you describe your investment philosophy?
Well, it's nothing controversial. I'm looking for good quality companies which we can hold for the long term. So there's nothing controversial in that whatsoever. When I started this 20 years ago, I was very hung up on valuation. And so I'd sit there and do spreadsheets and work out what was a good price to pay. And I'd sell things when things got up to that price. These days, it's evolved a lot more in recent years where I'm still looking for good quality companies. I still want to hold them for the long term. ARB and Reece are probably the first two companies I put in the fund, and I still own them 20 years later. But in recent years, I'm not quite so hung up on valuation. I let things run, and we'll probably talk a little bit more about this in the investment process, but I let things run a lot more as they go, and I don't hold as much cash as I used to. So when I first started, I'd always have quite a bit of cash because I'd always be thinking, I need some cash for opportunities. These days, I tend to be very fully invested, only a couple of % of cash. And if I see something I want to buy, then it becomes a two process. Then it's something I want to buy. It means I've got to have something I need to sell. And so my next investment opportunity has to be better than the worst idea in my portfolio. That's my opportunity cost now. So the cash has been a weighting on my portfolio. My investment returns have always been better than the cash return. So the cash has been like a weight. So now I look at it that my opportunity cost is the worst idea in my portfolio at the moment.
On that idea of, there's value in the name of your fund, but the concept of value investing, well, it obviously had a difficult 10 years as growth investing and, those big American tech names really just overtook the market. Do you still consider yourself a value investor?
Oh, look, there's many nuances in that name. Now, when we started 20 years ago, I was very hung up on valuation, so hence value was in the name of the fund. I wasn't just sitting there buying. You've got to remember this was just after the internet boom. I wasn't buying story stocks. I was buying businesses which I could value, look at their cash flows and that sort of thing. So value was in the name then because that's how I looked at the world. These days, I just call it an investment fund rather than anything else because I'm not quite so hung up on that valuation anymore.
Yeah, fair enough. I think a lot of new investors, you start by reading Intelligent Investor and the Buffett letters, and I certainly went through this, and I certainly consider myself a value investor early days, looking for nets and all of that. But I think, the more we do this podcast and the more we speak to experts, you really learn that those labels aren't as black and white as it feels, and it's a lot more interchangeable.
Very much so.
But Wayne, as well as the changing of the philosophy over the 20 years, one other thing that's changed is the assets under management, and it's a pretty incredible story. In 2002, you started with less than $100,000 assets under management. Today, you manage $65 million. Tell us about that growth story and what you've learned over the time.
Well, the 100,000 really was just the initial seed capital that we put in. Was just ourselves and then just the investors have just grown over that time, and had some financial planners, seeders with a fund as well. So so that's just how it's gone. It's just been a gradual process. I mean, the GFC was fairly ugly, which we'll probably talk about. It's just been a gradual compounding over 20 years. It wasn't a get rich quick sort of a thing by any stretch.
So Wayne, we're obviously in a part of the market cycle at the moment that a lot of the Equity Mates community might not have ever experienced before, or it might be only the second time that we're experiencing a significant downturn. You've been managing gains through 2008, 2020, and now 2022. What advice would you have for those that are experiencing this for the first time when it comes to actually investing through downturns? Is there any tips around portfolio construction rules that help you allow to capitalize on moments like this? What is your process when you're experiencing a downturn?
The first thing you say to yourself is, this too shall pass. If you long enough, this too will pass. I would say to you, the way I sort of think about it is really understand the businesses that you own, and if you're right about the business and you can look at the business will get through these periods, you don't have to worry about the market so much. If you're right about the business, they're well funded, they're not loss making, they don't need to raise capital. That's what's going to get you through these periods. And if you don't need to transact, just don't look at the market. I mean, if you're not buying or selling that day and you own the business, I mean, if you own shares in Woolworths, you can see people walking in and out of the supermarket. I don't need to go and look at the share price and tell me that business is going okay. So looking at the share market every day is just going to give you a whole bunch of anxiety you don't need, especially if there's a lot of red there. So if I look back at the GFC, and I actually think what we're going through at the moment is pretty mild compared to the GFC or even COVID. There was a period there in the GFC between January 2007 and March 2009 before we got the bounce. That 20-month period, I had 15 down months out of 20. Every single month it was just grinding down. And it was down, the fund was down 50% from top to bottom. Some of those months were down double digit. And it wasn't as if we couldn't predict that. In fact, there was lots of people saying, look, this American housing market, it's going to collapse. This is not going to be good news. What I think most people did was and me included, just under-anticipated how bad this was going to be. But I had good businesses. I didn't have any businesses that went broke. I had ARB and Flight Centre were my two biggest holdings through that period. They came out the other side. So this too shall pass. The other side, and especially if you've got a lot of years in front of you, your target market's probably got 30, 40 years in front of it. What's happening in the next 6 months is really not going to be important in the scheme of things. But as long as you understand the businesses you own and you understand how they operate and that they can get through these periods, that's more important than the market itself. I mean, if we look at COVID, I mean, that fell 25% in 2 months. That was a very short fall. But when I looked at that, I thought, well, I didn't waste time trying to work out, well, how many people are going to die? I didn't even understand what the lockdowns, I grossly underestimated what the lockdowns would do. But the first thing I did was I looked through my portfolio and thought, okay, well, can these guys all get through it? And most of the companies I own don't have debt. So that was a non-issue. So I thought, well, if that's the case, this will get over, we'll pass through this pretty quickly. I was buying with my ears pinned back, and I wrote to my unit holders in March 2020 saying, this is the best opportunity we've had for 10 years and likely to have for another 10 years. I've got everything in here like this. And I was buying Lovisa at $2.50 because you could just see people panicking on the screens where people were just coming in on the open and just absolutely, pounding on price. And you could see that these were not informed sellers. These were people who were just panicking and wanted to get out of the market. So you just don't want to be a panicked or a forced seller. You just want to have businesses will be around and you just stick with them. And as I say, we'll forget all about it. In 5 years' time, we won't ever remember this now, or we won't be talking about it. Like, you'll be talking about something in 5 years' time.
Yeah, this too shall pass. Love that. I guess you said earlier that the cash weighting was a drag on your portfolio compared to your investment returns. And so over time, you had less and less of a cash weighting. And that makes a lot of sense in, 2009 to 2019 where, life was good. But in a market like this, where a lot of stocks, the majority of stocks are down, that cash weighting sometimes outperforms, but also there's an opportunity there to deploy cash. How are you thinking now about the reducing that cash weighting? And I guess, you said in 2020 you were buying hand over fist. Did you have to sell opportunities? You had to sell companies that were down to then free up that cash to buy?
Yes, I sold little bits and pieces here and there, but I was fortunate. I had some unit holders, putting money in. They could see it as well, and I was looking around for every dollar I can get my hands on to stick in the fund. So it was just one of the. I said, at least a joke at the time. I said, I'm looking for 20-cent pieces down the back of the lounge now. I'm just sort of trying to find. And, to put in the fund. So, so the cash weighting, I'm not trying to predict when the market will turn because invariably I'll be wrong. I had no value to the equation there. My ability is to find businesses that will grow over the next decade or more. My ability is not in picking. People like Stanley Druckenmiller might be able to pick markets. I can't, and I don't pretend to. If I did, I'd have to admit I was lucky.
Well, Wayne, you'd be interested to know that Alec sold his car to try and free up some liquidity to get into the market. So I must say he didn't get a lot for it though. So
I empathise with you. I don't think there's screaming buyers in this current market, but I'm finding things that I think you'll do well from here. If you're buying certain companies, you'll do okay from here.
Well, we can't wait to unpack some of your top holdings and some of your opportunities a little bit later on. But we want to turn to your investment process because it's all well and good to know where you are in a market cycle and know that you have an opportunity to take advantage and have some cash on the side or potentially not as much cash as you would like, but looking to invest. Then it comes down to actually finding those investments. So what is your process to discover potential opportunities? I'm probably a little bit different to most. My process is I'm actually trying to screen things out rather than screen things in. So I don't tend to run screens on the market at all because the things I'm looking for don't screen well, like management quality, capital allocation skills, they don't screen. They're not in a spreadsheet. So I'm looking for businesses that can just grow over the next decade or more and can get high returns on incremental capital. So what I tend to do, and I only probably put one new idea in the fund each year, so I don't sit there. I'm not coming up with lots of ideas and going, what am I going to buy now? It might literally be, I put 2 new companies in the fund this year, which is Whitehaven and New Hope. Last year was one company, which is PSC Insurance. I'm a very low activity kind of a guy. So I'm just doing a lot of reading. I read annual reports. One of the things I have changed in recent years is I use YouTube a lot. I'll search for CEOs and watch them giving presentations at conferences and things like that, just to get a bit of a feel for the person. Because when they're doing ASX earnings announcements, they're very scripted in what they've got to say there because that's what they're giving the ASX. Whereas you can find them talking at conferences and they'll go off script and they'll talk about their business and they'll talk about things that they might not talk about in front of analysts. So I use YouTube. I'm just reading. I listen to lots of podcasts these days. So to give you an example, a few weeks ago, I listened to a 4-hour podcast about a business called TransDigm, which is a business in the States, not because I want to buy TransDigm, but because I can look at that business model and think, okay, well, is there a business like that in Australia where I could see how that model might work? So I'm using podcasts, just read a lot. It's very eclectic and it's more a process of screening things out. It's like a job interview.
where you've advertised for someone to come and work for you, you're not sitting there trying to find, out of the 100 resumes you've got, you're not trying to find all of them. You're just trying to get rid of the 98 or 99 that you don't want to interview.
Was the 4-hour podcast on TransTime, was that business breakdowns?
No. It's called 50X, which is... but I listen to Business Breakdowns as well. Business Breakdowns would be one of my favourite podcasts.
Great
podcast. A new podcast called 50X.
Okay.
And it was 4 1-hour shows, and you had the founder on there.
Wow, okay. Yeah, I love how much information there is out there. And listening to you talk about your research process, when Bryce and I quit our day jobs to do Equity Mates full time, that was my vision of what we would be doing, just listening to podcasts and researching companies. And we haven't quite got there. We decided to throw a massive festival instead, but hopefully we can get back to that, because it sounds like really just intellectually stimulating, just being able to learn and then being able to find ways to monetize that learning. You mentioned that some of these companies you've held in the fund since day one, or you've held for more than a decade, and I think that's really the North Star for a lot of people in our audience, finding those long-term compounders that can just grow. And as you said, they're not, you can't find them on a screen. You can't screen for sustainable competitive advantage. You can't screen for ability to reinvest earnings over time. So I guess the question is then, like, what are the hallmarks of those companies, and how do you actually go about identifying them in your companies? You said you screen them out, but for that one a year that you for a company that you put in, how do you actually go about researching it and giving it that tick against your investing checklist?
So what I'll do, I'll read the annual reports, and I'll read a whole arc of annual reports so that I get a bit of a feel for, okay, well, they said this year, and I'll build a financial model of the KPIs that I'm looking for, the indicators I'm looking for. And I might make some notes there where he said, okay, well, in 2012, they made this acquisition. How did that work through the P&L? In 2015, they said they were going to do this. How does that sort of work through? And I've just got a whole bunch of indicators. I'm just building this financial model so I can look at the history of the business. And it's not predicting, it's just looking at the history of the business. And so you're looking at, one of the biggest things I look for is profit margins. So if you look at something like Lovisa, which is in the fund, 80% gross profit margins. Now, if you can buy something for $1 and sell it for $5 to someone, you're doing more than just selling a product. You're selling something that people are happy to pay for. You look at PWR, 30% profit margins. So that's the sort of thing. Profit margins are one thing. One of the things that the guy in TransTime said, he said, I want to buy a quality business. And the guy said, well, what to you is a quality business? And he said, well, it's a business where they have some intellectual property and they're a small thing going into a big thing. Now, that couldn't describe PWR better, because PWR makes cooling systems for Formula One cars. It's only a very small spend in the overall spend of a Formula One car, but it's mission critical. So a Formula One car, if their radiator stops, if the cooling system breaks down, the car will stop. So it's mission critical. They can charge it. They've got pricing power because they've got intellectual property, and it's a small thing going into a big thing. So that's one of the things I'm looking for. So I'm also looking for businesses where they're just trying to reduce customer friction. So if you look at Domino's Pizza, everything they've done for the last 10 years through their apps and the artificial intelligence is all about speeding up the process for someone when they buy a pizza. So that's, if you can see where they're just so focused on the customer that they're trying to reduce that friction for the customer, they're customer focused, then that will show up in the numbers. So profit margin, return on equity, return on incremental capital, and then it's a case of me saying, well, okay, they've done this for, say, 10 years. What do I think, can they do this for another 10 years? And that's how I sort of think about it.
Yeah.
So I'm trying to get away from just the story stocks where you've got a CEO coming to the market promising that he's going to, take over the world when he hasn't even sort of got off, ground zero yet. So I'm looking at guys who've done what they said they were going to do, and I'm pretty confident they'll keep doing what they've done in the past.
Well, I'm interested to unpack some of the holdings, and you've mentioned PWR holdings there and Whitehaven and Lovisa. And Lovisa is a stock actually that over the last few weeks, I reckon, I've heard 3 or 4 people talk about. So looking forward to hearing your thoughts more on that. But let's start with PWR holdings. It's your number one holding in the portfolio. You did just briefly mention what it does.
Yep.
Maybe if you can just expand on it a little bit more, but also if you could talk to the bear case, like what would it take for the thesis to change and for it to no longer be part of the portfolio?
PWR listed about 2016, I want to say. So I've pretty much owned it since the day it listed because I could see this was a great business. And I have to sort of say PWR, I've been able to hold that and buy it in 2016, hold it for 6 years because I owned ARB for 15 years prior to that, because it's sort of a bit similar in the way it works. It was a business that had some intellectual property and it was mission critical in something that was bigger. So ARB is a mission critical suspension system in a forward drive. So Keith Wheel is the founder of the business. He started 20 odd years ago with his son, Paul. And so PWR is actually Paul Wheel Racing. That's how it became PWR, but Paul's not involved in the business anymore. Matthew Bryson, who's the chief engineer there and also a large shareholder, they were at a auto show in Germany and they said, look, we'd like to get into Formula One. And at that time, there was a competitor called Marsden, and they had their solution was they would make the cooling system for a Formula One car and they'd say, here's the radiator, you've got fitted in your car. Keith turned that around and said, you show me where you want it to go and I'll build a radiator for you and solve your problem. So McLaren was the first team, but then Red Bull said, look, can you go and make this radiator? And I can't remember the numbers, but if you can reduce the weight of a car, it's worth X amount of seconds per lap. So Red Bull said, can you reduce the weight of this radiator by X amount? And that should help us. And anyway, they did that and some. And then Red Bull obviously won the championship. And of course, it was off to the races because then all the other teams started to want to get into PWR. And if you look at the factory when you're down there, it's just an amazing work set up how they got it down there. Like the guys doing F1 have got their own Formula One booths, and you can see pictures of the racing cars and the teams there. So the guys, and you sort of work your way up the line. So Formula One's obviously the pinnacle of it. They do every Formula One team on the grid is theirs, but they also do Rallycross. Rallycross is a great customer because they just smash their vehicles up all the time. So that's what you want. Formula E, they're doing that. I think 22 of the 25 cars at Le Mans use PWR in their cooling systems. And when you say cooling systems too, it's more than just a radiator. They've got to cool, the more electronics you put on a car, the more you've got to cool that as well. So I think there's something like 14 cooling systems on a Formula One car now and just getting more. So that's the sort of thing that they do. And I guess the smarts there is that they've got engineers that can design these things, but then they've got the smarts to be able to turn that into a physical product which you can put into a car. Like there's probably engineers who can design it, but they've got the smarts to be able to put that into a physical product. So it's a beautiful business. And when Marsden, they took over all the Marsden business, and Marsden couldn't sell their business because they use this technology in aerospace. So it was only natural that you could join the dots that, okay, well, PWR will now go into aerospace because they've got the technology to do that. And sure enough, that's where we're at now. So Keith came out and said in the last 6 months that in the next few years, probably next 3 years, the aerospace part of the business will be bigger than the motorsports part of the business. So they just cracked $100 million in revenue for the first time this year. So it's growing very nicely, very profitable, high returns on equity. Keith is a founder and he's a real go-getter founder. And Matthew's there is the chief technology sort of guy, and he's just a very smart guy who can design these things. So it just ticks all the boxes for me in terms of what they're doing. And I think this aerospace will be, lots of opportunities down the track for them. And they also do high performance cars. So if Mercedes is doing like a $400,000 high performance road car, it will have PWR cooling system in it.
I'm looking at the price chart this year, and between May and June, it fell a bit over 40%. And then since then, it's rebounded and it's sort of back to where it was. What happened in late May, early June?
I think it was just a case of it was late to the party and falling. Like everything else in my portfolio had fallen 40% between January and May, and it didn't held up. And I thought, oh, well, that's nice to know. But then it fell as well. So I think that was just market forces. There's no news around it, and I said that in the June update. there's no news around this except that it was probably a bit on the expensive side, and people thought, well, I've made money on this, I'll sell this.
And now they're back in.
And they came out with a really good result, and not only a good result, but you can see now that this aerospace and the new technology stuff is really starting to take off.
We've had experts talk about PWR on the show before. I believe Emma Fisher from Airlie also chatted to us about it. Yeah. It's such a fascinating company, and I love finding these companies just operating in niches that I never would have known about if I wasn't doing this podcast. It's a really reminder of how lucky we are. But I think about who they're supplying to, the best Formula One teams in the world, with teams of hundreds of engineers designing their cars. And I often think, like, what's to stop them doing it themselves? Or, what's to stop other companies around the world seeing what PWR are doing? And, you explained how they sort of flipped the design process on its head and, were able to work with these car makers a lot better. What's to stop other competitors copying that business model, or, the Formula One teams with these big engineering budgets doing it in-house?
Well, I don't think they have the manufacturing process or the desire to go and do it. So those Formula One teams, and you've got to remember, cooling is only one part of the car. I'd understand that if you're talking about the motor or the tyres, where that's a much bigger part of the system. Cooling systems are quite minor. It's mission critical, but it's quite minor in the actual budget of a Formula One car. I could be wrong, but I think Ferrari spends like $300 million on their Formula One team per year. And I'm just guessing, but I would think that PWR probably gets 15 million of that, maybe not even that much. So it's a very, very small part. So, and that is the advantage, that someone coming into that industry, there's just not enough business there for, now that they've gone and got all that industry, all that business, there's not enough scale for someone to come in there and sort of say, oh, well, I want to get that business as well. And also, you've got to convince them that they've got to change as well. That's not easy if you're dealing with someone that it's a mission critical part of gear on the car.
Great business.
It is a great business. Probably the biggest risk actually for the business is if they change the Formula One rules to look more like NASCAR, and they say, okay, we want all the cars to look exactly the same going around the track. And so therefore you just end up with the same gear inside. I mean, it'll be incredibly boring for the sport. And I don't think Liberty, the guy who owns Liberty Media, who own Formula One, I don't think they would allow that. But that would be the bear case for them, that they just standardise. And that's only Formula One. So Formula One's only one part of that business. But I think if they standardise the rules for cars in Formula One, that would probably be the biggest risk to the business at this point in time. But I don't see that happening for years.
Well, Wayne, let's turn to your second largest holding, and potentially the sixth, because they're both in the same category, and that is coal. So Whitehaven Coal and New Hope. Obviously, coal's been having a great run. We look back on the last 12 months, and I have had no exposure to it or anything like that, but if you have, you've obviously done pretty well. So what's the thesis here? These long-term plays? Is this why these two companies?
So every now and then I find opportunistic things which I think there's very little downside here, and I should be able to double my money regardless of how markets perform.
Jeez.
At the start of the year, my portfolio was looking expensive, and I wrote to the unit holders in December and I said, look, the share prices have got ahead of the value of the portfolio, so we might be in for a bit of, I called it subdued returns. I wasn't expecting a 28% fall, but I said, we're probably going to have some subdued returns. It sort of came up on my radar that the coal price had popped up, and I was just talking to a friend, and you can work out the P&L of a coal company quite simply. Once you know the coal price and you know how much it costs to get out of the ground, you can work out the P&L or the cash flow of the business pretty quickly. And so I thought, hang on, these things are selling for like 1 times cash flow if this spot price stays where it is. And so that's as simple and as complex as it was. I thought, okay, well, I'm buying something for 1, maybe 2 times cash flow. They were already making fairly friendly noises to shareholders that, you've had some lean years, we're going to give this money back to you, either through buybacks or dividends. And so I just looked at that and I thought, okay, this is a fairly safe place to put some money where I've got very little downside. And I thought, look, if this doubles over the next 2 years, that will be a good outcome. It's more than doubled in 6 months. So it's sort of, it's gone a little bit quicker than I thought it was going to. But this is an opportunistic play. if we're having this conversation in 5 years' time, I'll be incredibly surprised at Whitehaven's in the portfolio. Then it served a purpose and it's serving a purpose at the moment, but it's not the sort of thing I would go and load the portfolio up on.
So Wayne, on those coal companies, you're mentioning it's opportunistic. Would love to understand when you think about selling, but before then, we're just going to take a quick break to hear from our sponsors. So Wayne, before the break, we were talking about two of the major holdings in your portfolio, Whitehaven Coal and New Hope. And unlike some of the other holdings, which are, these, multi-decade long time horizon investments, these coal investments have been a little bit more tactical. And so it's probably a good opportunity for us to unpack your process around selling investments. So I guess let's start generally. When do you know when to sell? What are you looking for? And then specifically about these coal investments, what are some of the indicators or factors that will tell you now's the time to get out?
So generally, I would like to think if I've got the business right, I never need to sell. In days gone by, I would sell on valuation purposes. These days, I don't do that. Just because the share price has gone up, it's not a reason to sell. So I only ever sell if I want to buy something else and the thing I want to buy I think is a better opportunity, or the business is broken, or the business thesis is broken where they said they were going to do something that hasn't worked, or I'm not happy with how their capital allocation skills are going, or if I've just made a mistake about the competitive advantage of the business where I thought they had a competitive advantage and they just don't, and the world has changed. So in general, that's what happens, and that my portfolio turnover be less than 10% per annum. So it's a very low turnover by most standards. So I only pretty much sell when I make a mistake is the general, or I see a better opportunity. In terms of the coal stocks, I will either sell them if I see other things which I think, I'd rather have my money in XYZ rather than this, or if I think, the risk-reward relationship isn't there anymore. So when I was buying this on 1 to 2 times cash flow, there was a very high reward to the risk you were taking. At $11 a share and probably about 4 times cash flow, the reward now is not as good as the risk that you're taking. So that's how I'm thinking about it. There's no time target, there's no price target. It's just how that risk-reward relationship goes and what my other opportunity set looks like. So some of the other stocks that I know very well and I'm very comfortable with, if they were to halve from here, well, I would sell Whitehaven in a heartbeat and buy something else that I prefer for 20 years.
Yeah. Well, let's turn to the third stock in your portfolio, which is Lovisa, a discount jeweler, I would say, or cheaper jewellery.
Low price, they might want to say.
Yes. So talk us through the company. You mentioned there you love the margins that it has. As I said, I've heard it brought up multiple times this week. So talk us through what the company is, what is the thesis, and why you love it so much.
Lovisa is, as I say, it's a low-priced costume jewellery business. So if you're looking for a piece of jewellery for your wife, you're probably not going to go to Lovisa. But if you're an office girl and you need a pair of earrings for the races on Saturday, you might go in there and buy these earrings for $10 or $20 or for work or whatever. So they have an 80% gross profit margin and about 20% profit margin operating once they pay their costs. They started off about 10 years ago. Brett Blundy is the chairman and he's the largest shareholder in the business. And Brett Blundy is a retail genius. His shareholding in Lovisa these days is worth about $1 billion. So that's how successful it's been. They now have about 650 stores and 150 of those are in Australia. Australia's pretty well built out now, they've said. That's a mature market. But Australia's only 150 of the 650. They've gone off, America's the main market now where they've got about 115 stores over there. But they're also expanding into other markets. They've got a new CEO, a guy called Victor, who's a Spanish guy who used to work for Zara or Intech and also worked for Guess. And now he's been incentivised and heavily incentivised to roll this out and grow the business. It's got wonderful economics. So the stores are about 50 to 80 square metres. My guesstimate is a store turns over $600,000 to $800,000 a year. So the sales per square metre on these stores are really good. Very easy to roll this out. Costume jewellery, women the world over wear it. And it's a single line. business. So I think there was a competitor in Australia not so long ago who went broke. And if you're going to be in the fashion industry, from my reading of it, if you're going to be in the fashion industry, you're either at the very bottom of the price market in the budget area, or you're at the very high end. So you go, Louis Vuitton makes 80% gross profit margins, and Zara and Lovisa make 80% gross profit margins, and then it's a race to the bottom as you go back in towards the middle. So you want to be at one end or the other, and you want to stay in that end. There was a competitor that had discount, low-price costume jewellery, but she was also doing handbags as well. Now, you would sort of think theoretically, handbags, 80% gross profit margin, that should work. But it's a different business model, because when you walk into a shop to buy a handbag, you're not buying that thing in 5 minutes. You're going to sit there and look at it. You've got to have space for it. You've got to train the staff differently. This costume jewellery is just people are buying this stuff every week or every 2 weeks. It's a repeat business. It's a single line business, and it doesn't take much of a store footprint. So this thing can grow for a long time to come. They really surprised us with the results in for 2022. Profits are up over 100% on the year. I mean, it was extraordinary. And I can just see, if I had to pick one stock in the portfolio which might surprise me over the next 10 years, Lovisa would be the one.
Wow.
Love that.
It's fascinating. It's a fascinating company. It's like fast fashion for jewellery.
Yeah.
Really. Just get it cheap, get it out the door, change your lines, constantly have new things coming in and out.
What's its competitive advantage though? Like, what's stopping Ren and I going to Alibaba? Not that we have any knowledge of jewelry, but like getting cheap jewelry and just setting up a small shop and pumping it out the door.
Because it's the logistics behind it. You could do it, and I'm sure you could do it for one store.
I don't know if we could do it, to be honest. It was a strange analogy that Bryce used.
But you know what I mean? Like, there's no innovation in product. There's no, like, you can pick up that product pretty cheap from China.
Couldn't that argument be made for most retail businesses?
Yeah.
I was going to say, you can make that argument for Zara too.
You could, yeah.
And you can make that argument for Walmart. And you can make that argument for Costco.
Yeah.
You could.
These guys just keep... It's the logistics and the culture behind that you don't get. And again, they just reduce the friction. So when you walk into a Lovisa store, if you're buying a piece of costume jewelry, it's not behind counters, it's sitting on a rack. It's a very easy decision. And if I get it wrong, okay, I've blown $10 or $20. You're just reducing that friction, and because they've got the scale there, you would think it shouldn't do as well as it does, but I can sort of see why it does do as well as it does. The risk would be if they became a multi-line. If they went and did the same thing as some of these other competitors did and thought, okay, well, we do costume jewelry and we make really good margins on that. Let's do something else that we can make good margins on. I think that's where they would go wrong, and they would, your sales per square metre would drop, your store footprint would go up, and that would be a disaster.
Yeah, because I was thinking a little bit differently to Bryce. I wasn't thinking that he and I would go on Alibaba and start buying jewelry, but I was wondering, like, what is to stop the other fast fashion players, the H&Ms and the Zaras, from really having it going head to head with Lovisa? And I'm sure they do. I'm sure they have cheap jewelry at the checkout and stuff like that, but the sales per square meter, like the fact that you can cram it into such a small store, is something that a lot of those fashion retailers, like those clothes fashion retailers, I guess can't do.
No, it's not their focus. Look, I'm sure people do go into H&M and buy costume jewelry. I mean, you're not going to get 100% of the market. But if I'm walking through town or a shopping centre, I think, I need a pair of earrings for the races on Saturday or for drinks on Friday night. Lovisa is just that one. It's going to be one of the names that goes through your head. And that's what Harvey Norman used to say. He said, people are going to go and look at TVs anywhere. I just want to be one of the three names that people think of when they're looking to buy a TV. And I think Lovisa's in the same boat. Yes, you might be in H&M buying a dress and you think, okay, there's some earrings on the counter, I'll buy them too. But if you're just thinking, I want to get some earrings for an occasion, I don't want to spend a lot of money, you just want that to be the top of mind, or you're one of the choices that they'll make when they're making that choice.
Well, three blokes talking about buying jewelry, probably not the experts in the field.
I have bought jewelry from Lovisa.
Have you?
Yeah, costume.
Okay.
Super easy, super cheap.
There you go.
And if you make the wrong decision, you're not going to get bent out of shape.
They're also massive in rural towns, massive in Wagga.
Oh, really?
Yeah.
There you go.
Yeah.
Let's talk about one other company quickly that you mentioned earlier that isn't as big as these. I think it's the 8th biggest holding in your portfolio, but it's definitely one that is front of mind for a lot of people, and that's Domino's Pizza. And when you were speaking about it earlier, you were speaking about how it's just so focused on cutting friction. And surprisingly enough, pizza has been one of the best growth stories on the Australian share market. Forget tech. It's all about pizza. But Domino's hasn't had a great year this year. It's down 42% year to date. What are your thoughts on Domino's at the moment?
I still like the business, and I think if you go back and look, if you look at Domino's 10 years ago, they did $200 million in turnover. They had 1,000 stores. Most of them were in Australia. If you look at Domino's today, and like they basically had just the Australian market and a bit of New Zealand. If you look at Domino's today, they're doing $2 billion in turnover. They've got nearly 3,500 stores. It's a global, or not a global business, but in multiple markets. And a wonderful, wonderful management team. And they're just getting scale in some of these European countries like France and Germany. You're just starting to get scale where the television advertising really drops through and you can pick up customers. I just look at this as they've had one bad year. You just have to, that's part of being in business. The Japan, there's two reasons, but for me there was two main reasons why the profit fell this year. Japan came off sharply because when people were in lockdown, they couldn't go to restaurants, so they were buying takeaway pizza. They set the business up thinking that, okay, well, even when the lockdowns come off, they'll keep buying pizza because that's what they did around the rest of the world. In Japan, they didn't. They started going back to restaurants. So, and they'd set up all the marketing spend as if they were going to keep getting those customers. They didn't come through, so the profits in Japan went down. The other thing they've done is they've taken over the area for Denmark, and they lost $12 million in Denmark. Now, that will build that business back up. So I'm not terribly worried about it on a year-to-year basis. I mean, they're going in the right direction. They've got new territories now in Malaysia. Japan will just keep growing. I mean, that business is going to be a really good business in a decade's time. It's got the highest number of stores per franchisee. It's one of the things I really look at is the stores per franchisee, because if you've got existing franchisees buying new stores or adding new stores to the business, then they're making money and they're happy. It's when you get franchisees' numbers dropping, that's when you've got a problem. And the numbers in Japan are still going up. So, I think it's a wonderful business run by a wonderful management team. They're just so focused on the customer. They've got to the stage now where when you order a pizza, they know that, say, Alec, when you ring up, say you always get a ham and pineapple pizza. Well, when you order up, when you ring up now or start using the app, they start making a ham and pineapple pizza. Now, you might change your mind and say, okay, I'm not going to have a ham and pineapple pizza, but someone else will. So they just keep making it because someone else will order that pizza. But they've just got it so that they can just, the smarts are there, so they're just making this process faster and faster and faster. And I don't know whether Don May was listening to Jeff Bezos, but he's all about the customer. You just got to reduce the friction points for the customer. So they're growing. Australia's a mature business, but the rest of the world, France, Germany, Japan, they're going to be big, big businesses in the next decade. They've gone from 1,000 stores to 3,500 stores in the last decade. I see no reason they won't be at 6,500 stores in another 10 years' time. So worrying about the price of cheese or the labour cost and whether they're going to meet their profit projections for the next 6 months is just not something I'm worried about. That's information that won't last. It's permanent information I'm looking for and what I think they can do in the next 10 years.
All right, well, Wayne, we want to say a massive thank you for joining us today. We have almost run out of time. If people want to find out more about yourself, your investing or gains, where should they be going?
Well, go to the website. It's probably the best, www.gainscapital.com.au, and probably read my fund updates. I sort of put a fair bit of effort into those because I want people, even if you're not a unit holder, I wish people wrote those letters when I was starting out. And so the idea behind the fund updates is to give you some information about how I think about markets and the investment process and why I own the things that I own and how those business models work. So they're the sort of letters that I wanted to read when I was starting out. So that's why I'm writing them the way I do. It's not because I'm trying to be smart and get new investors. It's more I want to help them. I look at the Nick Sleep letters that he wrote for Nomad, and I just think they're brilliant, and I'd like to emulate that in Australia.
Yeah. We often talk about how underutilized and undervalued investor letters are, and we're pretty lucky that we can read them from investors all around the world. But Wayne, we'll get into these final three questions, and the first one we like to close the interview out with. Do you have any books that you consider must read?
Yes. I mean, as you can see behind me, I read a lot. I won't recommend Intelligent Investor because I think Intelligent Investor is a very dry book, and it's probably something you want to read 5-10 years into investing. So I've got 3 books here which I would recommend. The first one is Common Stocks and Uncommon Profits by Phil Fisher. This guy had about a 60-year career. He only owned 14 stocks in his entire career. Most of his money was in four of them. And he was all about, and Warren Buffett says I'm 15% Fisher. He was all about buying good quality businesses and just holding them for years and years. That book's 70 years old, but it's still fairly accessible. The writing's fairly accessible. But if you want to read about an individual who sort of took that process, this book here called The Davis Dynasty is a biography of Shelby Davis. Now, Shelby Davis borrowed $50,000 off his father-in-law after the Second World War, and he turned that into $900 million by the time he passed away in the 1990s. And he donated all that $900 million to charity when he died. And all he did was he invested for the long term, never owned a company. He wasn't a founder. He just mostly invested in insurance stocks. He knew the insurance. He was an expert in the insurance industry, and he just did that by buying that. And as a bit of trivia, his grandson now sits on the board of Berkshire Hathaway, Chris Davis. The other one that I've really liked is if you might sort of say, well, Shelby Davis did that buying insurance stocks, and you couldn't do that now. But this book here called 100 Baggers by Chris Mayer, that just shows you that there is 100 baggers everywhere in the market. And that's, again, it's be patient and good things will happen. The other book I just briefly mentioned is Richer, Wiser, Happier, because it's got a chapter in there on Nick Sleep and all the letters he wrote. So it's worth it just to buy for that one chapter. But it's a good book.
Yeah. Love that. 4 great book recommendations, and you've mentioned Nick Sleep a couple of times there. If people have read the Buffett letters and they're wondering where to go next, I definitely think he is next on the list. But Wayne, the second question we like to close the interview out with, forget the company as an investment today, forget what it's trading at, just purely on what the company is, what it does, and who runs it. What's the best company you've ever come across?
Google. By a mile.
Nice.
Google that won't be displaced in my lifetime, I don't think. YouTube and Google search and Google Maps, it's a brilliant business.
Yeah.
The world has fundamentally changed before that business is buried.
Crazy if we see it overturned in our lifetime. Crazy.
We just have to make sure that we're paying enough attention to the stock markets to get on that company.
That would be wow. Wow.
Final question. If you think back to your younger self investing in Pacific Tires for the first time, what advice would you give to your younger self?
I'll give you 3 pieces of advice to make you happier, richer and wiser. The first piece of advice is I'd say don't look at the market every day. It will drive you nuts. If you're not transacting on that day, the price of what you own won't matter. And that will just make you take so much anxiety out of your life instead of seeing red and green arrows up and down on the screen. So don't look at the market on a daily basis. The second thing I would say is when you're looking for information, try and find information that's going to last and it's going to add to your knowledge of how the world works. So whether that's getting accounting knowledge or whether it's getting knowledge about psychology and how markets behave, or whether it's learning how scale works and how business models work, go and find information that's going to last a long time and add to your base of knowledge. Don't go hunting for what I call decaying information. So trying to work out whether Domino's is going to beat their 6-month forecast, that's information that is useless in 6 months' time. So you want information that just adds to your knowledge base. So that will make you wiser. And then what will make you happier, or richer, I should say, wealthier, is stop trying to make market forecasts. If you get the business right, you don't have to worry about the market. And the business is, you get your returns from the business, not from the market, and predicting whether this was the right time to buy it and this was the right time to sell it. So stop looking at the market. Make sure the information you're trying to gather is long-lasting, and make sure you're right about the business and stop trying to make market forecasts.
Love that. 3 very actionable pieces of advice to close it out there, Wayne. Very much appreciated. And thank you so much for your time this morning. I know that plenty of our audience would have really taken a lot away from that. You've certainly got a lot of market experience, and in a time where we're experiencing volatility, some of us have never experienced a downturn like this before. Those pieces of advice there really do provide a bit of comfort. So we appreciate you spending the time with us today. Thank you.
You're welcome. So this too shall pass.
This too shall pass.
This too shall pass. Yeah, love that.
Thanks, guys.
Thanks, Wayne.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.